Hi guys, Kirk Chevis, First Commerce Financial. All right, we're going to talk all about the bank statement loan, what it is and what you need to know about it. Before we do that, hit subscribe and ring that bell below so you're notified every time we put out great content. So next is Ken Turkington, my business partner, and myself talking all about the bank statement loan. Have a great day. Ken, we are live. How are you, buddy?
I'm good. How about yourself?
I am doing fabulous. Let's get into this bank statement loan. I know a lot of people are going to have some questions. We get a lot of questions on it all the time. So what is it? What is a bank statement loan?
A bank statement loan, short and sweet, it's an alternative way to qualify for financing for self-employed borrowers where we don't look at the tax return. We look at the amount of deposits that go into the bank account over 12 or 24 months. And that is the income that we get to use to qualify. There's a couple of asterisks at the end of that, but that's it in a nutshell.
All right, so that is the what. So self-employed only. Self-employed only, okay.
And to use the bank statement deposits. You can, though, be self-employed, use bank statements, and then also use a spouse that has W-2 income. So if we're using bank statements, though, that is for the self-employed borrower, whether it's solely or we factor in something else.
Okay. Why can't we use their income on W-2 or on their 1099s or their tax returns, or why not that?
And there are a number of different ways that people structure their business, and accountants' jobs are to make sure that a business owner is not paying more in taxes than they should. So they're looking to take advantage of every possible write-off, whether that really affects their cash flow and the money that they receive, but it helps mitigate tax obligations. So if the tax return has substantial write-offs for whatever they may be, that the taxable income will not allow you to qualify, this is the perfect alternative.
Okay, so first thing everybody's wondering is, what's the rate premium? Something like this.
Totally. And the rate premium is about 1 3/4%. So if current interest rates, I'll just use round numbers, are at 5% on a W-2 or a taxable earning qualification, interest rates for this program are going to be around 6.75.
Okay. Why are we hearing about it now? What is it about this time in spring buying season's going?
Yeah, we've got two components.
Okay.
One is the genesis of this loan program started about 4 years ago. And if we go back to prior to the housing bubble, there were no income verification loans that filled some of this gap. Those were gone until about 4 years ago, where the industry said, if we can find a way to prove, different than tax returns, what money's coming in, so that we can show, based on the money coming into the account, associated expense ratio, if we can show that's there, that is documenting income just in a different category. So this has been growing in popularity of understanding and being able to make sure that there's a need for this and that it's done responsibly, not like back prior to 2008, that there's a need for this program in the marketplace. So it's been growing because it's proper. And then now the nation's largest wholesale lender that we deal with, they just rolled it out this week. That's becoming more common now for the industry because there's fewer loans being originated than what we had 6 months ago. So all lenders are now embracing this where they didn't have to before.
So more self-employed folks now than there were prior to the housing bubble bust of 2007-8.
Yeah, you would think that COVID may have caused more people to entertain thoughts of, hey, instead of being an employee from a company, what if I'm an independent contractor and I work remotely? Sure. It's very plausible to think that self-employed borrowers have increased.
That makes total sense. Okay, and we have exploding house values still, mortgage rates climbing, typical qualifying, like you said, as a W-2 wage earner, it might be a little bit more difficult or more challenging for these folks. So this is an option for them to look at if they can't get in the regular format.
Yeah, and if we go back to prior to the housing bubble that was, we'll call it '07 through '08, there were a lot of non-responsible loans out there for people to take advantage of. You and I, we didn't embark on that because it didn't feel right for us. I view this as a very responsible loan, meaning that there is much more detail obtained from an individual to show the money that's going into a bank statement, where in the past, you just simply, Kirk, how much money do you make?
Wink, wink.
More. Well, yeah. And went, great, we'll get your loan approved with no basis to know that they qualify. Down payment increments are also greater now, which requires more skin in the game.
So you were getting into a little bit of the how they work and what the underwriter is looking at. Give me you said 12 months, 24 months bank statements. What are they doing in there again when the underwriters are looking at those bank statements?
So they're looking at the deposits that go into the account. There's some rules and guidelines that they may have to omit some of the deposits, but what they're looking for is a body of work. So if your business account is averaging $20,000 in deposits a month, that could be 8 one month, it could be 32 the next. It still gets us to that average over a period of time. So the shorter the period of time that they're going to review to get an understanding, it's just a slightly higher interest rate. The longer period of time that they review, you're going to get just a slightly better interest rate. But they look at the deposits, put an expense ratio attached to that, leaves us with a balance of funds, and that's now the income, and we go right back to normal qualifications.
It's hard for the non-self-employed person to understand the cyclical nature of running a business. So they're not looking at P&Ls, balance sheets, monthly P&Ls, things like that. So it doesn't necessarily make sense to them that they could have 8 in revenue, 20 the next, 40 back down to 5. That makes total sense of why they're extending it over a period of time. You are showing a history of the type of revenue you can generate over a long period of time. That I get it. That makes sense. So you hit on the rate stuff. You hit on looking at the bank statement. What can we use this for? What type of properties?
But it's wide open, just like a normal financing. So it can be a primary residence. This isn't the type of property, but the property can be a primary residence, a second home, an investment property. The property types can be, a single family home, a condo, a townhome. So once we get that income part figured out, it's very, very similar to a traditional mortgage after that part. Loan amounts.
Where do they go bad? Like where does it like hit the fan sometimes on this type of product?
It's just the borrower's understanding of that rate premium. So understanding that, hey, I'm early on in my business life cycle. I can pay a premium for a certain period of time until my tax returns allow me to go back to best case scenario. Or for the borrower that does have a history, and there are opportunities that the accountant can take advantage of to make sure that they do the math to say, what I'm not paying in income tax is a bigger number than the premium that I'm paying for the rate. But that's the sticky spot right there.
Customer says, well, heck, I don't want to pay a 1 3/4% premium on the interest rate on my $400,000 loan. Why should I have to do that? Right? That's what you're telling me?
Yes.
And then you direct them back to the last 2 years or last 1 years of tax return where they would have been paying X, Y, or Z if they had claimed it as taxable income.
X times 3, 4, or 5. Or
Sure.
Let's look at the fact that you can go now as opposed to waiting. Leave appreciation out of the mix for a while, but there's family dynamics that say, I gotta put my elbow to my back because my family needs a place to call a home. An opportunity may present itself that slight increase that you're paying is worth it.
Okay, so if you're thinking of switching jobs, going from a wage earner to self-employed, check in with us right away before you do that. If you're 6, 12 months in, check in with us. We'll help you work through what you've done and maybe what you need to do as far as adjustments over the next year. But that is awesome information. Again, this is for self-employed folks. We're talking about bank statement loans. They're becoming more and more popular. They're not as dangerous as they were in the 03 to 07 range, I'll call it, where they weren't verifying anything. They're actually looking to see that you're generating revenue now.
Yeah, I used this example the other day. If we go back prior to 08, the industry felt like anybody that had a pulse should be able to, is entitled to get a home loan. And now we're saying, all right, if you can illustrate in a different format that you're financially capable, then there should be an option for you.
Great stuff. Tune in for the next episode of whatever it is that we're going to talk about, but this should help a lot.
We should call it Who Knows What.
Exactly. Thanks, Ken. Have a great day.
Take care. See you, man.
Bye.